There are many reasons that investment real estate is favorable from a taxation standpoint. But the X factor that really helps investors continue to defer receiving, quote, income is depreciation. But not all depreciation is counted equally. To be more specific, certain physical components of real estate assets can have highly favorable depreciation schedules if you go through the cost segregation process. We're going to focus on this particular element of real estate investing and get into the details with a cost segregation specialist. So in this discussion, we're going to talk about when you should consider pursuing a cost segregation analysis. What asset classes are best suited for cost segregation? What happens with a cost segregation analysis if you're investing through a self-directed IRA or another tax-advantaged account? And we'll also discuss some of the recent laws and how they may impact discussion around cost segregation, especially as it relates to real estate. Okay, I'm about to make an announcement, which I want you to take seriously. I am a huge coffee drinker. Well, first of all, I only drink 1 cup a day, but I really love that 1 cup. In fact, I make my own cold brew at home, and this has allowed me to experiment with different coffees, and I think that I have found the best coffee ever. Now, before I go any further, I want you to know, yes, it sounds a little biased. I'm an investor in the company, but I'm putting my name on this. This is no joke. The breakfast blend from Thrive Market is my favorite coffee that I've ever tasted. Simple as that. I wanted to share this with you in exchange for something. You guys know what's coming. You have the chance to win your own bag of what I believe to be the best coffee on earth. The next 5 people to leave a review for our show in iTunes. You're going to win what I believe to be the best coffee. Here's what you have to do. Number 1, leave a review in iTunes. Number 2, screenshot the review, email it to me at info@asymcapital.com. That's asymcapital.com. Don't forget to include 2 things, your mailing address and to tell me if you want whole bean or if you want the coffee to be ground up when you receive it. That's it. This is only going to be valid until the end of September, and only the next 5 people that complete those steps are going to actually win the coffee. I'm telling you, I have tried Bulletproof. I have tried Illy. I've tried them all. But Thrive Market's breakfast blend is literally my favorite coffee that I've ever had. So I want to share it with you. I want to also give you an opportunity to leave a review for our show. I know a lot of listeners out there have enjoyed these programs, enjoyed the conversations extensively. So go to iTunes, leave a review, win some coffee, have a productive morning, and hope you enjoy the episode. How's it going, everyone? Our guest for today is Yonah Weiss, who is a powerhouse when it comes to property owners' tax savings. As business director at Madison SPECS, which is a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others, and this passion has led him to speak across multiple mediums, across podcasts and conferences, etc. So it's an honor to have him on. So Yonah, thanks again. Welcome to the program.
Thank you, Hunter. It is a pleasure to be on your show.
Yeah, much appreciated. So let the listeners know a little bit about your background. We're always going to talk about cost segregation today, but I want to talk about kind of the big picture, and then we'll work our way into the details.
Sure. A little bit about my background. Grew up in Southern California, then went to college in San Diego. Led me to move actually to Israel for about 15 years and spent the majority of my time teaching and studying. I have a big family, 6 children, and I love teaching. I got involved in real estate about 5 years ago, investing in some single family fix and flips, and then wanted to learn more about the business in terms of actual commercial real estate. Learned a little commercial mortgage brokering and residential brokering as well, and got my feet involved in a lot of different areas until I met up with Madison Commercial Real Estate, which is the company I work for currently, doing a number of different services, and cost segregation has been my number one focus for the past 2 years or so. So happy to share my wealth of knowledge with the listeners and anyone who wants to hear.
So this is obviously a topic that we've talked about a few times in the program, but we haven't done an entire episode on it. And the truth is, I actually get questions about this topic all the time because there's some intricacies here. There's some scales of when it's appropriate, when it's cost efficient, when it shouldn't be implemented, etc. But before we even get into that level of detail, let's talk about why this is important. So one of the things that people find really compelling about real estate, it has the opportunity to appreciate in value. Now, the other side of this, which is less commonly talked about, is depreciation. Why don't you walk us through the difference between those two and how this then applies to cost segregation?
Right. Well, appreciation, let's just get the terms straight, right? Appreciation means the property is going up in value. And depreciation, even though it means technically that the property is going down in value, in the context of real estate and in taxes, it actually has almost nothing to do with that fact. So it's really a tax deduction that the IRS created based on the fact that property does go down in value theoretically, meaning things have a useful life and wear down as time goes on, even though simultaneously the property itself actually may be increasing in value and most of the times is increasing and appreciating. So depreciation, we have to think of this kind of taking it out of the real sense of the term and understand it from a tax perspective, that it is a write-off based on, kind of theoretically that the property is going down in value.
Right. And so I guess another way of putting that is depreciation should be thought of as a tax term as opposed to kind of a real estate investing term, in the sense of
Correct.
It's a phantom loss where you want depreciation. You want the physical, actual, tangible assets of the property to be depreciated, because that is a loss, not the type of loss that comes out of your pocket, but the type
Correct.
of loss that basically comes at the end of the year. So how does this then tie into the cost segregation discussion?
Great. So, and I'll just take it one step further when I say it's theoretical. So cost segregation and depreciation is based on the purchase price of the property when you bought it. So that's what I mean to say. It's theoretical. If I bought a property for $1 million, I can take the tax write-off of $1 million, spread that over the useful life of the property, which is 27 and a half years for residential or 39 years for commercial. But if I go ahead and sell that property a year later to someone else for $2 million, they now take that $2 million basis of depreciation and write that off. So, and this can happen unlimited amounts of times. So that's why I say it's almost theoretical, because it doesn't have to do with the property itself actually going down, going up in value. So that's something really important to keep in mind. And really, it's almost ludicrous to think about, like, this really doesn't have to do with the real value of the property or how much useful life it actually has, because it could have been built in 1912 and we're depreciating it again for 27 years if I bought it today.
Yeah, that's a good point. Actually, before you even jump on, just to clarify again, It could be the case that the property value has tripled, but the asset, like the physical property in itself, some of the physical components of the asset have been completely depreciated. So most of the time that these appreciation versus depreciation conversations happen, basically it's just because the words sound the same. Doesn't mean that they actually apply to the same meaning.
Correct. Okay. Yeah, excellent. So that's exactly the most important part to keep in mind. So now in terms of cost segregation, so the IRS, like I mentioned before, gave a useful life to properties. So they gave for commercial properties 39 years and residential, which includes multifamily, even though that's also commercial, a little bit confusing, but anything that's residential people live in is over a 27 and a half year period. But they also created other useful lives of property, which is in real estate. So things like personal property, tangible property, which there's tons of things that fit into that actually depreciate over a 5-year schedule, according to the IRS. And that can include things like, in a property, you have stuff that's not part of the main structure of the building, like, furniture, fixtures, appliances, carpeting, you name it, a lot of different things. Now, outside of the building, there's other stuff depreciates over a 10-year schedule. 15-year schedule is the biggest other category, which is land improvements, like landscaping and pavement, parking lots, etc. Stuff outside the building. All of that stuff depreciates really on a 15-year schedule. Now, when people go ahead and depreciate their property or take that tax write-off, most of the time, they're just going to be using what's called the straight line depreciation and lumping the entire purchase price, the entire building, into one category, which is that 39 or 27 years, and depreciating the entire amount over that time without taking into consideration that the IRS actually explicitly said there are other things that depreciate at a faster life and really should be taken, those assets on that schedule. Now, cost segregation is the involvement of an engineer who has, sufficient knowledge in the tax code, who can actually do this, who can actually separate out all of the things in the building into these different tax lives and depreciate them over that time. So that's really what cost segregation is taking the cost of the building and segregating it down into categories. I hate the name. I don't know why the IRS gave that name. It used to be called component depreciation, which makes much more sense. But cost segregation, as confusing as it is, that's what it means, is segregating out or separating out all of those assets into different categories and depreciating them, each one over its own life period, which ends up accelerating a large portion of the depreciation had you not been doing that.
Right. And without even breaking out the financial calculator, it's just not that complicated to understand. But let's say, for example, you have a typical property that's 27 and a half year depreciation. It's a small percentage that's written off every single year. The shorter the depreciation schedule, the larger the write-off. And the key component here is that you're taking it sooner as opposed to later. You're depreciating the entirety of that particular asset over a shorter period of time. So just to give a big example, and I probably should look this up before I went on the air and said it, but I believe that private jets have a 5-year depreciation schedule. Generally could be wrong about that, but regardless, it's a short depreciation schedule. And so if you had a $100 million jet, you could see that every single year this would be a massive, massive write-off for you because the physical component of the jet was being written off. And I've actually heard about people that are up in that centimillionaire, billionaire stratosphere buying jets like that and using them because it's actually good business decision because of that segregation of that particular asset and the schedule of the depreciation.
Correct.
So going away from the private jet life, which we're all aspiring to be, to the real estate investing life, let's talk about how expensive this is. When does this make sense? And also give us a range in terms of what you look at to identify how expensive a typical cost seg will be.
So we, Madison SPECS, we're one of the largest national companies doing this. We don't take any, contingency fees. So the expense is usually based, we have a kind of rubric that we use based on the scope of work, square footage, size of the property type of what the engineers and our accountants and our whole team will have to spend, the time and the effort doing it. Usually runs, I'd say, average properties is somewhere around between $4,000 and $7,000. So it's not a large expense, especially when we're talking about some people creating tax write-offs in the hundreds of thousands or millions of dollars. So in that regard, it's pretty small. The larger the property is, if it's a larger commercial property, let's say a large office building or a larger shopping mall or something like that, the expense is going to be a little more because of the amount of work that's involved. Now, when would it make most sense to do? I usually like to say because what we discussed, before is that this is a percentage of reallocation. We didn't get into all the details of how this works, but if you can think about it, it's usually about a 20% to 30% reallocation of assets into those faster categories, getting larger deductions earlier on. It usually makes sense on any property. My rule of thumb is any property purchased for over $1 million. It makes sense to at least get the numbers, to run the numbers, which we do for free to get an analysis for free, just upfront to show you what the potential benefits would be. It usually makes sense. Anything below that, it could make sense, $500,000 and up, but usually we're talking about larger commercial properties that we're doing this. And just to give you a little information, historically, part of the reason why cost segregation isn't that popular or has just become more recently popular has to do with actually the market, because it used to be, kind of cornered. The market used to be cornered by the large accounting firms. The big four large accounting firms used to have engineers on staff and were doing cost segregation in-house. Up until about 10, 15 years ago, only large corporations and people that were buying, large commercial properties even considered this. But now, since the market has kind of taken over, a number of companies popped up over the last 10, 15 years, and it's become much more affordable. So when it used to cost about $40,000, $50,000 to get a study done, it was only reserved for much larger properties where the tax benefit warranted that.
Yeah, that's interesting. No, I'm actually, to be honest with you, I'm a little surprised. $5,000 to $7,000. I was anticipating it being 2 to 3 times that for sure. So that's really good to know. How does the hold period factor in to this discussion? in the sense of if you're only holding the property for 1 year, should you factor that into your decision as far as doing that cost seg?
Absolutely. Yeah, there's always going to be a number of factors that are going to come into play when considering if it's going to be worthwhile or not. And one of those things is going to be the hold period, because what we're doing with cost segregation, we're not creating new deductions. What we're doing is we're accelerating a portion of them. Now, if you're holding a property for less than a year, first of all, most of the times not allowed to do cost segregation, because holding a property, if you're just flipping a property, like just a buy and quick sell, if you didn't have intention on holding it for more than a year, then it's actually not even considered rental property. It's considered more as a business transaction, which would be not allowed to have depreciation taken from it. So cost segregation doesn't even come into play. However, another thing to take into account is the time value of money. And that's really what the main essence of cost segregation is. Right? We are creating these deductions, getting that money earlier on as opposed to later on. So one of the most important factors to take into consideration is that when you sell a property, you have a tax called depreciation recapture tax. Okay, without getting too complicated, you have to pay a tax based on the amount of depreciation that it took. It doesn't mean you pay back the entire depreciation. It just means you pay a tax on it. Now, taking a lot of depreciation up front and then knowing I'm going to now have to, in a year or two, pay a tax on that. So that has to be strategically looked at from your tax perspective. Is the time value of money that I'm having this for the next year or two worthwhile? Usually, the arbitrage between the tax rate that you may be paying versus what the depreciation recapture tax is going to be enough that it's worthwhile in most cases. But I'd say at least 2 to 3 years is a good hold period to make it very worthwhile.
Okay, that's good to know. And we've actually touched on a couple things that I'm actually interested in diving in deeper. So just to put everything in perspective so the listeners are following along. So in a typical real estate syndication, which is what we typically invest in, let's say you invest in a property for 5 years, you invest $100,000, you could get an average of $7,000 per year during that 5-year period. It is very common that during that 5-year period, all of the cash flow will be deferred from a tax standpoint, in the sense that you're receiving that cash flow, but you're not actually showing a gain because of depreciation and a variety of other write-offs that benefit the real estate investors in the United States. Then at the end of the hold period, you sell the property for a gain typically, and then you pay long-term capital gains. But in addition to long-term capital gains, there's also something called depreciation recapture tax. And that's what you're just alluding to. So what are the typical tax rates of that depreciation recapture tax? And let's say that in my example where you invested $100,000 and you received $7,000 a year for 5 years, so $35,000, what would you anticipate paying for that tax at the end in terms of cash flow, not the long-term capital gains part?
Right, for sure. It's a little bit of a complicated question because it would have to do with more on your cash flow. It would have to do with the amount of depreciation that was taken. So it's kind of hard to reckon that without knowing more information. But let's just create a hypothetical scenario just for our listeners. So if you took, $100,000 investment, $35,000 return over that hold period, right? And let's say that the entire $35,000 was deferred because of, let's say bonus depreciation, cost segregation, whatever it is, the other tax returns. Let's say, on this property of that $35,000, $30,000 was actually depreciation that was distributed to you as a investor, because it's broken down usually according to the number of shares a person has in a property. Right. That's the amount of depreciation they'll have. So the percentage is, is broken down. So let's say they got their allocation of the depreciation over that whole period was, $30,000, let's just say. So of that $30,000 that they now got the cash flow, that $30,000, when the owner goes to sell the property, that $30,000 or the entire amount, but broken down for you, is now going to be taxed at usually a 25% tax rate. So 25% of 30,000 is going to be, what is that? 70.
So $7,500 tax.
Yeah, exactly.
Okay.
Exactly.
Yeah, that actually makes a lot of sense and is definitely aligned with what I'm seeing. But it's also very favorable, right? In the sense that, number one, the tax rates are lower in the sense that depreciation recapture tax is typically lower than a lot of accredited investors' income tax.
Exactly.
And also, you're not having to pay it until year 5. So you're getting not only the ability to defer those taxes, but when you do receive that $35,000 in cash flow, you're actually able to reinvest that cash flow as well, or spend the money. That's another way of saying invest it. But that's kind of one of the reasons why this cost segregation is so advantageous, but also why just real estate in general is so advantageous from a tax standpoint.
Exactly. There are a couple more important things to realize when doing this. Now, a lot of people with syndications may not be able to take advantage of this, but with a 1031 exchange, that's actually a way to not only defer the capital gains, but also to defer further on the depreciation recapture tax.
Okay.
So that's something to consider as well, that it may, just be pushed down the line even further. Another thing to consider is that a lot of times in syndications, if there's a refinance that takes place, which is, kind of a redistribution of the investment, that's not a taxable activity, which means, you may be getting your cash flow from the rent that's coming to you, but you may also get a big bonus check of if there's a refinance that happens on the property, and that money that comes to you is not taxed.
Got it. Okay, cool. Makes sense. Any other parameters that you wanted to discuss in terms of, and of course there's many, but particularly as it relates to whether or not you should consider moving forward with the cost segregation analysis?
Obviously, the main thing to consider is the price point. Does this make sense? And that's why I said it's always worthwhile to get that kind of free analysis, to kind of look at it and see, hey, does this make sense in our situation? The other thing to consider is if for some reason, actually there's two things. One thing is that a lot of people, it's become a lot more popular recently of people investing through their self-directed IRA, right? Their retirement accounts. Now, retirement accounts are not all created equally, but many of them are not taxable because basically those monies are not taxable. Therefore, if you invest in them, they don't get the tax benefit because the only one that can get depreciation deduction is someone that's taxable. So a nonprofit does not get depreciation. It's not a tax write-off for someone that already is nonprofit, right? Governments don't as well. And for that reason, retirement accounts that are investing, most of them at least, are not taxable. So someone who's investing in a syndication through their retirement account will not benefit from the depreciation, will not benefit from the cost segregation. And that's actually something a lot of syndicators take into consideration whether, doing a cost segregation or not. We'll say, hey, 50% of my investors are coming from retirement accounts. They're not going to benefit from it. Is it still going to be worthwhile for everyone else?
Interesting. And I don't want to make a mistake here, but I know that there's actually been some changes to the laws in terms of 2018, in terms of actually basing the depreciation schedule less favorably because of self-directed IRA investors. I don't have the article in front of me, so I won't go into too much detail, but it's something that you can look into with your CPA. They're basically, if you invest in a syndication and 30% of the investors are self-directed IRA investors, the depreciation schedule is not going to be as advantageous, which is unfortunate. And that's something that's relatively new. But good point, especially during this conversation. I know a lot of our listeners do use self-directed money as a vehicle for their investment in real estate. Mm-hmm. So let me ask you something. What are the more favorable asset classes when it comes to cost segregation? Are there specific property types where you see a more significant amount of the physical items being depreciated over a shorter period of time?
Yeah, absolutely. So like I mentioned before, there are things in the building that are not considered part of the structure that depreciate over a 5-year period, and stuff outside the building that's like land improvements that's considered 15-year property or 15-year depreciation schedule. So stuff like certain asset types will have a lot more 5-year property. If you take, for example, assisted living facilities is a big one, right? Or skilled nursing facilities, these type of properties where you have tons of equipment in each room, appliances and certain types of, the beds are very expensive. So when the engineer comes into the properties, taking account of everything in each unit and, adding up the totals of everything based on industry standard costs of everything. And so, stuff like that are extremely expensive are going to get a much higher write-off, whereas in a regular multifamily property, you may get somewhere around 20% of the 5-year property being reallocated. In a assisted living facility, it may be closer to 30 or 40%.
Oh, okay, cool. What about hotels? How do they fit into that picture?
Yeah, hotels are pretty aligned with multifamily.
Okay.
Give or take. They're pretty much along the same lines in terms of the percentage of allocations. Certain type of heavy manufacturing facilities will have a lot of equipment, and that might be a great opportunity for cost segregation. And I'll take on the flip side, there are certain types of properties that have a lot of 15-year property, which is the land improvements. Whereas in a regular multifamily garden style apartment building, you may get, anywhere from 5 to 15%, so let's say around 10% of the property is going to be reallocated to landscaping and pavement, carving, parking spaces, fencing, signage. If you have a swimming pool or playground equipment, all of that is 15-year property, according to the IRS. But there are some properties like a golf course is great, my favorite one. Okay. Golf courses are actually like 70 to 80% in most cases, 15-year property. It's land improvements. It's considered landscaping. So that if you buy let's say you buy a golf course for $1 million, you can actually write off, and we'll get into in a second, the bonus depreciation, which is the new law. You can write off on a 15-year schedule as opposed to the 39-year schedule about 70 to 80% of that, which is incredible if you think about it. Let's say you bought that with financing, with a loan, and you only put down 20%. You only put down $200,000. Now you get a $700,000 tax write-off, right?
Yeah.
And with bonus depreciation, you can get that all in year number one, which is crazy. You spend $200,000 and you get a $700,000 tax write-off.
Understood. And actually, the mobile home park business is also mostly considered land improvement, somewhere in that 60% range.
Correct.
So it's definitely advantageous from there. Okay, so let's talk about how this works in practice. We do hear a lot of people talk about the benefits of depreciation, et cetera. My experience has been that, at least in the syndications that I've invested in, it's not that there's a tremendous loss every single year. It's more that the cash flow is deferred from a tax standpoint. Do you see a lot of deals which are throwing off significant losses on an annual basis, or are most of the deals kind of net break even in that 0% taxable gain area?
You mean with the cost segregation? Is it creating a large loss? Is that what your question is?
Yes.
Yeah.
Okay.
Yeah. So, yeah, exactly. Well, I think part of the thing, and I'll just preempt because this is going to come up probably, and I mentioned it just in passing a second ago about the bonus depreciation. So I'll just bring it up now because there was a new tax law in the tax reform last year in 2017, 2018, created something called bonus depreciation, which allows property owners to take all of that 5-year, 15-year property in the first year, to take all the depreciation in year number one. It's called 100% bonus depreciation. So instead of doing the regular cost segregation, spreading that out, accelerating that to a 5-year schedule, scaling to 15-year, you can take it all in year number one. What that does is, people who are utilizing that oftentimes will, create a huge loss. There may be substantial reason to do that for some, and for others, it may not make sense. But going back to the original question, which is if, the regular cost segregation is doing that on a case-by-case basis, meaning if we're looking at one property at a time, so then the answer is it's probably not creating a large loss. It's usually bringing it down to zero, maybe creating a small loss. But a lot of syndicators and, property owners, whether syndicated or not, are usually looking on a bigger picture, okay? Because depreciation does not, obviously for investors, they're just looking at it for, per investment, but for syndicators or for real estate owners, they're looking at it at their whole portfolio, which depreciation can actually be spread around and be used to offset gains from other properties. So they may want to do congregation and take that bonus depreciation for their overall benefit and not necessarily for this one property.
Perfect. So you just touched on something that I want to make sure we talk about, which is kind of using the depreciation around in other investments. So 2 questions. First of all, why wouldn't you want to take that loss up front in year one? What would be some of the reasons why you wouldn't want to do that?
One reason is that with the 100% bonus depreciation, there was another law that came into being, which is that passive loss carry forward is now limited. Okay, it used to be when you create a passive loss, meaning when you create too much depreciation that you can no longer offset any taxes this year, it doesn't go away. You don't lose that depreciation, but it just gets what's called carried forward. It goes into a passive loss, and it creates like I like to think of it like an imaginary bank account where that extra depreciation wasn't used this year. It can now be used going forward in the next year or in subsequent years. So one of the rules that came about with the tax reform was that passive loss that's carried forward can only be used in subsequent years to offset 80% of income in future years. So if you want to use that imaginary bank account next year, it will carry forward with you, right? But you may not be able to utilize the entire amount of it, or you do not utilize the entire amount, but use it to offset your entire income.
Okay, got it. And so that's one of the reasons why it's less favorable given that change there. But generally speaking, I think that the change is very positive. It's just that you have to understand where you're really coming in. So let's talk about partial asset disposition. How does that conversation tie into the discussion about cost segregation?
Sure. So partial asset disposition means that when you sell a property, we mentioned before the depreciation recapture tax, which means that you have to now pay a tax on the amount of depreciation that you took. However, partial asset disposition means when you go and sell a property, you can actually allocate a lesser amount to certain types of assets, certain property within the building that has already been depreciated or, so to speak, disposed of. It hasn't necessarily really been disposed of, but it can actually be seen as of disposed of. Like, let's take an example. Okay, you have an apartment building and you have an HVAC system. Okay, and that HVAC system depreciates over a 5-year period. Now, say $100,000, and you're depreciating that every year, right? 5 years. After 5 years, theoretically, and I say theoretically again because it's still there. When the new guy buys it, he's going to take that $100,000 HVAC system and write it off again over a 5-year period. But you, when you're selling it, can actually allocate a smaller amount, a lesser amount to that, which means it may not be worth. It's already been quote unquote depreciated. So I can allocate a smaller amount to that, about $10,000 to that. If there's no asset left, then there's no depreciation recapture tax. So this is actually a huge strategy that a lot of people use to get around the depreciation recapture tax when utilizing cost segregation.
Yeah, that's important. And how commonly do you think that is utilized? Like in a typical real estate syndication deal, is that something that's used all the time, 50% of the time or less?
It really depends on the tax planner. You know, I know there are certain tax firms that come out that this is their standard approach. You know, the strategy, this is what they use. Others that, you know, they don't want to be quote unquote more as aggressive as that or whatever. So I don't really know, because it really depends, you know, person to person or tax planner to tax planner, what their method is.
Understood.
But it is fairly common. I mean, I can tell you up front that I know at least two of the big four, I know for a fact use this standardly. And in fact, one of them uses it even after 1 year. They write off the entire asset after 1 year, even though it really doesn't depreciate until 5 years.
Interesting. So when I first started learning about cost segregation and depreciation, I had this idea. I thought I was the smartest person in the world, where I was going to buy a piece of property, cost seg it, let's say buy a private plane in my fantasy land, cost segregation, awesome, get the $100 million jet, you get the $20 million right after a year, and then at the end of the 5 years, rather than really sell the asset, I'll just sell the asset to another LLC that I own. Mm-hmm. What are your thoughts on that strategy?
Right. Yeah. So it doesn't work.
Yeah. In short, it doesn't work.
In short, it doesn't work because it's considered an arm's length transaction, which depreciation doesn't start over, and it's not considered a new entity. So similar to, you mentioned a 1031 exchange. I didn't get into that too much, but there's actually some overlap in terms of cost segregation 1031. But I'll just say the example you use, you're taking the depreciation and you're just transferring that. You're just transferring what you originally purchased, and the depreciation is transferred over to the new property, or to the new LLC. So if in the case of 1031, it's transferred to the new property, without getting into that too much, there's lesser benefit of a 1031 when doing cost segregation unless, a large amount is, added to the new property that you're buying.
Understood. So if you go all around the mulberry bush and you are the end owner, you really can't do that. It's against the tax law. And even if you try to get away with it, it's not legal. So you shouldn't try to do that. But definitely something I consider when I start to understand things. Okay, so we've discussed a lot of topics. I think that discussion about the partial asset disposition is something that is unique that people need to look into. Is there anything else on this topic? Obviously, this is a broad topic, but is there anything else that investors should look into themselves that we haven't talked about on this particular interview?
Yeah, there's something that, actually literally just came into my head right now, which is not talked about a lot, to do with what you'd mentioned before about transfer of ownership. Another very common type of transfer of ownership is, it's unfortunate, but a death, an inheritance. When you inherit a property, it's very favorable, because if you inherit a property, take depreciation on the fair market value of that property at the time of death. And, it's a pretty complicated to do that. I mean, it will take time, going through the lawyers, et cetera, and getting a new appraisal. But what that means is if your grandfather, not yours, but someone's grandfather, right, bought a property in 1954 for $10,000, and now it's worth $20 million. When you inherit that property, you inherit it at the fair market value of $20 million and now can depreciate that property as if it's new.
Whoa, I did not know that. Yeah. That is very significant. And the example you gave is a good one, because the key there is that that person that's inheriting it didn't have to buy it, meaning that they didn't have to put down that $5 million to buy that $20 million property. They could just receive it and then for the next 27 and a half, 39 years, depreciate that $20 million property. And even more favorably if they do implement a cost segregation. That's very interesting. Okay, cool. One other topic that I want to talk to you about, and I know that I sent you over a list of a couple of questions, and I didn't include this one, but I'm sure you'll be okay talking about it, is I noticed that you have been very active, very successful in terms of leveraging LinkedIn to build your personal brand, just you're a master networker when it comes to online component. I was wondering if you could share any of those tips that you've got from really leveraging LinkedIn in particular to establish yourself in the community, outreach to people, just be a person that is a person of influence, because I know it's been something that you've put a lot of effort towards and it's been very successful for you.
Well, thank you. It's true. I have put a lot of effort into it and it has been very successful. And I think the number one thing, and there I have a whole list because I have spent a lot of time on LinkedIn and learned very deeply the strategy. And every social media platform is different and works differently. It's the community is different and the actual algorithm is different and how it works is differently. I've studied very, at length from a lot of people LinkedIn, so I can just speak to that. I'm actually not very familiar with a lot of the other platforms and don't use them so much. And one of the reasons why is because I like the community of LinkedIn, that it's number one professional, even though it is social media and there's a lot of, similarities between Facebook, et cetera, but it's a professional feeling. So it's like networking. I feel it's like a networking event. And so you don't have to leave your house. You don't have to leave your state, whatever, to go to a networking event. You can actually have that networking event happening live all the time. But the number one thing that I've found about LinkedIn is that it's a platform to share content, and it really became that way over the last, I'd say about a year and a half, 2 years or so, when it changed over and became more of this social media platform as opposed to just a place to post your resume, which what it used to be. But it's all about adding value. Okay. It's all about sharing content that adds value. Now, adding value is very subjective, right? I mean, me posting an article about cost segregation may be beneficial for a few people. A handful of you might read it, maybe, but that's not what's going to add value overall. And I've found that the real adding value when it comes to networking is not about selling, okay, and not about trying to push your content. So adding value actually has to come from helping others, okay? And it may sound like, well, what do you mean helping others? Like giving and doing that, that's like, how do you have time for that? Giving to others and looking how can I help someone else without wanting anything in return. It's kind of a mindset. So I can't say this is something that everyone can do and should do. But that's what works, because when you're focused on giving and helping others and saying, what can I do to help them? What can I do to, help promote someone else's brand, someone else's product, someone else's business, even if it's very subtle, like liking their posts and commenting, giving them support, it actually comes back tenfold. And it's an interesting strategy, and there's a lot to it. So I'm not going to get into all of it, but I think that's the foundation.
Yeah, no, I appreciate it. And it's free, totally. Right? So it's a very good way to spend your time just interacting with people online, building those relationships. And to your point, it's much more scalable. It's 24 hours and you don't have to go through traffic to be at a permanent 24-hour networking event. I really like that. And it's something that I do casually, but I haven't really turned the professional energy towards it. But I'm definitely considering doing it because of, the success that you've had with it and other people as well. So, listen, man, I really appreciate you coming on. Obviously, we talked about a topic which is really important, especially with the new changes in the tax laws. So thanks again. And before we jump off, though, let the listeners know how they can learn more about you and your firm and get in touch with you.
Yeah, guess what? Check me out on LinkedIn. That's where you can find me right there. You can check out madisonspecs.com. You can check out me on LinkedIn. That's the best way to communicate with me. Believe it or not. Yeah, that's it.
Great. We'll actually link to your LinkedIn then in the show notes page. So, Yonah, thanks again.
Awesome, Hunter. Thank you for having me.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.